Hi, everyone. My guest today is Tom Braziel. Tom is the founder and CIO of 507 Capital, which invests in bankruptcy claims for crypto exchanges, among other things. Tom, thanks for coming on.
Thanks for having me on. I'm
So
delighted to
you
chat
were
with you.
now you were just asking me where I live.
Yeah.
So I live in Darien, Connecticut, and I lived in LA for 10 years, which was 10 of the best years of my life. It was
Oh yeah.
amazing. I loved it. But yeah, that's how
Nice.
I met Toby. I met Toby there. So Toby Carlisle, I met him. So I had a job where I had to contact a lot of people. We were doing proxy
Yeah.
battle stuff, um, and I wound up meeting him, and he and I hit it off immediately, and just hung out constantly for 5 years. And then he had kids, and then I had kids, and then I moved.
Right. You cut out a little bit on me, but I got I got
How
the.
do you know those
co-
guys?
How do I know Toby? I think Toby just reached out to me, and we got talking about like I don't know, sort of extreme special situation investing, and I don't know, we just sort of clicked. I mean, I from Toby I met Jake and Bill, but
They're
I don't
great
know.
guys too.
Yeah. For Toby, I'm just kind of talking about like extreme special situation investing and how I don't know. I think micro caps and special situation investing is kind of like going to the gym or something. You sort of like it's good to know how to work out, and then like you can tailor it towards yourself later if you want to go and do something else. I don't know. There's some metaphor there, but it's sort of our analogy of like it's good to learn the skills, like you might not want to be a
Mhm.
lawyer, but having a law degree can be kind of great if you go into business later or if you go into investing later and there's some legally driven aspects to what you're doing. You kind of have it in your toolkit. So
Yeah.
I'm kind of still stuck in like the toolkit area. I haven't quite left, just the hammer. I haven't
Well,
learned
that,
to be a finesse investor, the compound town guy, but
well, that's like
still
that's
working
like
on it.
Seth Klarman being like, I never
I know,
evolved
stunted
away
growth.
from Graham.
Yeah,
That can be a good
he's
thing.
he's kind of. I mean, yes and no, because like let's be real. He does a lot of privates. He does a ton of real estate, a lot of distressed real estate. Does a lot of distressed crypto. Uh,
He,
so
oh,
he go,
he does so much beyond that. He's such a better investor than Ben Graham was. I think it's not even close.
I think also like I think part of it's probably true. Like I know you don't write books as well. There's a fiction. It's like you have to take the people before you. You can't just like copy Hemingway. You have to like be like, oh wow, this person's like making my mind melt and explode with how genius they are. But then I have to make it modern. I have to like kind of take the tools and the whatever. I have to take modernity and like apply it to what I'm doing. And I think that's true. I think Klarman does a really great job of that. Like whether it's, playing the institutional imperative against distressed firms. So taking he was talking about in margin of safety, he was saying like everybody knew Texaco was a 100% rebate case when it filed, but distressed firms had like a 15% mandate. So we could go to the top of the stack and make 15%, and we were not taking any real risk. Versus the bottom of the stack, yeah, you can make 30, but you're risking a lot more. So like playing institutional imperative because of the rise of institutional investment in the distress world, and investors being siloed. So I'm a growth guy, I'm a value guy. Like you even see it now, and but think of how cheap things are. Like I can hire a lawyer in Darien, Connecticut, and have him work on something for me. I mean Buffett, yeah, he could do it over the phone, but he couldn't like look someone up, find someone, look at all the SEC filings, have a call with management. Like it's just you have so much more like
Hmm.
information that you can go further. I mean, you could potentially invest in a company in Sri Lanka. You could buy a stock in Sri Lanka. I mean, Buffett could never really do that. So my point is like you have to push the boat out.
Oh, totally. And by the way, back to your thing about literature. It's funny. I don't know if you like Cormac McCarthy, the author.
I have to say I'm very one dimensional. I know the name, but I'm not a big fiction reader,
Okay.
because I'm sort of obsessed with investing and I guess all things around the greatest trades of all time. But continue. I want to hear the metaphor
Well, I don't actually read
analogy.
a lot of fiction myself. I write it, but I don't read a lot of it. I only want to read what I think is the best stuff. I don't want to read the
Yeah.
average stuff or anything like that. And I think he's one of the best writers ever. But it's funny. He was saying he really likes Herman Melville, and I wound up rereading Moby Dick which is an unreadable book. It's utterly unreadable. But the 10% that's actually good is amazing. But I suddenly understood everything that Cormac McCarthy was going for. Like I suddenly got it. But it is funny. You do have to. It's weird. You can't just copy the people who came before you. It's almost like you have to like kind of like let it flow through you and inform you, and kind of give you new ideas yourself. And then if you're really good, you almost can't help but make it yourself, whether it's writing or investing or anything.
I mean, I kind of think like investments, like investing. Sure, there are people that work in the institutional world, and there are people that are extremely talented. Some of that is because they just like they're high performance people and they like succeeding, right? At whatever they're doing. And there's a whole swath of people where they just kind of love it. Like even if they suck at it, they will love it, and eventually they'll hit on stuff. So like that's how I feel. Eventually you'll hit on some stuff that works, and you should just do more of that. That's the trick. Do more of what works. Don't sell your winners. Let them ride. So I think there's something to be said for that in a business context, like kind of let your winners ride in the sense of what's working or what people will pay you to do. But yeah, I mean, think about it. Okay, I played tennis. People play the game of tennis has changed immensely just because of the technology, right? So if you apply that to investing, like the tools are so different. So maybe you could just do stuff other people couldn't. You could buy tiny securities, or you could buy bankruptcy claims in a way that you couldn't back in the day. The people that pioneered our space of like bankruptcy trade claim buying is a guy named Mark Lazary who runs Avenue, and I mean he's a super famous guy in distressed. And when he first started buying claims in like I think the late 70s, early 80s, I mean you had the changes to the bankruptcy code in 78. His sister tells the story of putting dimes in the copy machines at the clerk's office. So to get the creditor information, you had to go there physically and put dimes in. I remember that when I was a kid in the 90s. Like, I mean, I wasn't doing it for investing. I wasn't like this precocious 6-year-old like putting dimes in. My parents were bankruptcy lawyers, so I was down there, putting dimes in to get copies that my mom needed. But my point is like, for every give, there's a take, right? Like it was more costly to do and it was harder to figure out. But of course, the spreads were bigger. And that's the same thing true probably with crypto distress, right? You sort of, for me, it's kind of worked out in the sense of the spreads are huge because there's institutional imperative. They want access, but they don't really want to touch it. So they maybe want someone in between, or they can't work on small stuff, or, they're just not interested because, you're directional. So even though something's crazy cheap, they're like, but it's too directional. I'm like, but if you're getting, if you're buying something at a fifth of what it's worth, at some point you should be willing to take the direction. You should be willing to take the directional, even though you can't hedge it. So I'm always amazed when something can't be hedged, like how aggressively cheap it will be to market.
Oh, that's interesting.
Just because it's in a different wrapper.
Isn't it only in part directional because it's dollarized, right? Aren't all the claims dollarized?
Okay, this is a very interesting question. So like, okay, yeah, we'll go jump. So for FTX are dollarized. Under the U.S. bankruptcy code, technically claims are, like all these crypto bankruptcies have been dollarized. But in FTX, if it's determined that the crypto was never property of the state because the title never changed its hand, then it technically wouldn't be dollarized because it never was property of the state. And so things like in New Zealand, there's a case down there, and in Mt. Gox, the crypto wasn't dollarized, and that's because it was kind of thought that title never changed hands and it belongs to the customers. It does complicate things, but you follow me? So it really has to do more with I mean there are real legal questions here. But actually the big distress firms love dollarization. Like they love dollarization and they love estate professionals just selling off crypto like crazy. Because for them they're like, if I can buy something for 50 cents and make 60, or buy it for 90 cents and make 110, over like 2 years and make like a 15 or 20% return and do that at scale, I am so happy. But you say, like, if you give them a docket where they're actually long Bitcoin, like you could take 3 arrows, or there's a docket in New Zealand, which shall remain nameless, you can basically buy claims at a fifth of what they're worth. And you say, wow, 20 cents on the dollar. I mean, like in an actual dollar. The problem is the dollar is denominated in Bitcoin.
Right.
They look at you like, whoa,
Isn't
how can
also
I
the
hedge that?
exchange? Isn't the exchange holding it in their whatever their coin is? And so therefore, even if the claim is dollarized, you're still, if that coin crashed before you collected, then
Uh,
you'd be out your money, wouldn't you?
well, in the case of the one in New Zealand, or in well, that was Cryptopia New Zealand and Bitcoinica New Zealand. In those cases where it's likely, it's really just Bitcoin in the estate. So,
Hmm.
would you buy Bitcoin at a fifth or even a sixth of the market price? Where
Hell yeah,
so you, I mean, it's a pretty good bet. I mean, at some point you have
yeah.
to just, yeah. For me, I've had a lot of ups and downs in investing. I'm sure everybody has. It's been in it
Yeah,
long
me
enough.
too.
Uh, the stuff that's really worked for me has been stuff where I've just bought really cheap optionality. Where I didn't even envision some of the stuff that happened, but it happened, and I knew it was kind of in the cards, but it wasn't. It was just I knew it was really cheap. I knew the upside or the optionality I was buying was very cheap.
Mm.
Um, so sometimes like having really cheap optionality or asymmetry allows you to bet on something much bigger than you otherwise could.
Hmm.
Um, and so maybe like in Mount Gox, like when we were originally buying claims, that was really the trade for my family office to put that on in scale was, well, I can't buy $5 million of something that could be a zero, but if I buy under the cash value on the claim, I get the Bitcoin for free. Now that I can get behind, right? So it allows you to take an outsized bet. I suppose it's a little bit of a Soros idea. Soros is so great. And I think encapsulating this when he's like, when you think about what you can make and what you can lose, if something has a muted downside, that allows you to bet pretty hard. And I suppose, there's a whole, I guess, vein in the value community that feels similar.
Oh, totally. Is there? I mean, when I look back on my own investing, the cheap optionality is. I think that's where I've made almost all my money. Where and
Oh yeah,
people talk about asymmetries, right? It's become a buzzword
I know.
that's
I
used by
hate saying
people
it.
who. Yeah, exactly. I hate saying it too, but when I actually think about it, the stuff I've done well in is stuff that has that asymmetry because then you can put on a position in size.
Right,
And
right,
the reality is it's like it doesn't it's not a perfect asymmetry, right? There's always the possibility that it's worthless or just
right, right.
massively impaired, but it just kind of in terms of your gut feeling, you're like, I don't know, I just don't really see how, like a certain big business that's really cheap is a zero. That just seems very odd. Stuff
Yeah,
like
and
that.
I used to think, oh, sometimes I have this well, I suppose in investing you always have to be willing to hold like very what's the phrase? Uh Things that are totally in not contrast but not congruent with each other like in your head at the
Oh
same
yeah.
time like ideas that don't actually if you're like those are conflicting uh premises. I think so the cheap optionality is great, but then you and sometimes I think, oh, you can't know. I have this other idea that you can't really know too much, or you shouldn't overthink it. And maybe it's just about position size. My problem with that, like on FinTwit, you'll see people tweet about ideas, and you sort of think like, there's no way. Oh, thank you, sweetie. Just on a podcast with a friend. Um, that's okay.
Is your daughter
And
bringing you something?
no, my wife kindly brought
Oh.
me an iced coffee. I don't know,
Oh,
maybe
nice.
she was thinking, he's not making any sense. I have to give him some caffeine. Um,
No, you're making sense.
no, but
And by the way, you're welcome to say shit. You're welcome to say
oh,
shit.
Moa to curse. I'll try not
Oh
to curse
yeah.
too much.
Oh, I don't mind.
Um, uh, but my problem with that is like you never know. Like people say, oh, just size it like an option because it could be a zero. Yeah, but the problem is like it just like I was thinking about this like this whole you have to be so careful not to just buy lottery tickets because you can convince yourself of anything
Hmm.
and you can kind of get like wayward with like 2% positions. Oh, it's only 2%. It's only 3%. It's only 5%. It's an option. Just treat it like an option. It's like, but you're not like. I think you're better off making more errors of whatever omission and just stopping all the dabbling. I think the dabbling is where you don't get into trouble, but you just, yeah, maybe you are. You're just because taking your time away from really thinking thoughtfully around what you want to do and what you want to put on.
Yeah, you're just frittering away your focus. But I don't know. I think Soros is, going back to what you were saying. I think Soros is so interesting just in terms of his how he gets into the mechanics of investing. Something else I think is interesting about him is that someone was like, if this trade goes wrong, you could lose all your money and lose your career, and he was just sort of like, oh, I'd make it back again. And I wonder to what degree he just had this kind of not giving a shit attitude, because he really believed if he didn't view it as this is the only money I'm ever going to have in my life. He seemed to view it as play money, which is a very powerful mentality that I think very, very few people have. But then the people who do have it generally go bust. And for him, he figured out a way to just really to hit those asymmetries and use position sizing to like when he bet against the pound, like that is, I never even thought about it because I've been short the Hong Kong dollar. But,
oh yeah, you've been in that trade. I've been thinking about putting. I mean, I don't really know what I'm doing, so again, it's a dabbling. But yeah, go for it.
Well, it's a hedge for me. I just own I own stuff in China. And I don't want that part of the bet. And so I've just been hedging that out. But it occurred to me as I put it on, I was like, I really can't lose money on this. It's I can have to pay the money, the interest on it, but I really can't lose money on it. And then I understood why Soros encouraged Druckenmiller to put the British pound bet on in size, because it is truly asymmetric. It's like an option that doesn't expire. It's pretty amazing. And it never really made sense to me until I did
am I cutting out a little?
On a very small scale myself.
Sweetie, can you open the door in the other room?
Of course.
Thank you. Sorry, I'm just making sure I'm good reception for you.
Oh yeah, thank you.
I think Soros is amazing, and whenever someone brings up Soros, I always say you have to read Soros on Soros. It was an interview by Byron Wien, I think that's his name. The guy that I think recently passed away, and it's him being interviewed. So that is a great book, phenomenal, much better than let's just say much better. But The Alchemy of Finance is a little bit like Moby Dick. It's like, what are we talking about again? It's like, The Alchemy of Finance gets a little esoteric and quite hard to follow, but Soros on Soros is phenomenal. And one of the things he talks about is looking for, like in math, you would say, he called incongruous or incontinuities, like discontinuities. And so you're really looking for those big jump step functions where something can radically change. Because when you find those, it's like, if nothing changes, like you don't lose a lot. But if you it's not likely to happen. But if it does happen, like it's so off. The delta you can make is so big. I mean, I guess it's back. It's kind of that Steinhardt thing. It's like, the 4 quadrants of the Steinhardt. I always think that's always really great.
I don't know that.
Oh yeah! Oh, this is great. It's chapter 8 or 9 of No Bull, which is not a great book, but chapter 8 or 9 is good, where he talks about variant perception, and he has this idea that's like there's 4 quadrants, like the top column or the first column, or sorry, first row is like consensus views. The second column is, or second row is like non-consensus views. And then the first column is you're right, or no, sorry, you're wrong. And the second column is you're right. And so he's like, consensus and right is okay, but you don't really make a lot of money. Consensus and wrong is okay. You don't really normally lose a lot of money. He's like, non-consensus and wrong. Again, it's, you probably don't lose that much. But but the real golden ring, as he calls it, where you can make the biggest returns, of course, are like non-consensus and right. But he's saying sort of a precondition or to those really outsized returns are being non-consensus. Doesn't mean it's not sufficient. Or what are the phrases?
It's necessary.
I should know how to say this. Necessary,
it's
but
necessary,
not sufficient.
but not sufficient.
Yeah,
I
yeah.
happened to just be thinking about that the other day.
I think it's so. I think it's so true. I mean, but I'm pretty narrow in what I do, and if I'm really honest, as I've gotten older, I've really tried hard to stay to my narrow stuff. Like one of the early things we were doing, we were trying to buy claims in FTX and other things, was because of dollarization. There were a lot of like what are called, they're not called clawbacks in the bankruptcy code. They're like preferences. And my idea was like, okay, well, if you have a preference, if it's 100% repay in the case, which ends up looks like it's going to be, the preferences likely go away. And so why wouldn't you just buy the heavy preference claims really cheaply? And so I was sort of betting on something I knew a lot about. I could still be wrong, but I thought there was a big asymmetry. And you get these like micro asymmetries. That's the fun part about, I guess, doing distressed. But I do think it works on a macro level. I mean, you reminded me of this famous Philip Brothers guy, like Ludwig Jessupson or something, when we were talking about this. But I think that yeah, I don't know. I don't know what I feel woefully. I don't feel qualified to really give advice on this. I'm just like, as the more I talk, the more I realize, like, what am I talking about? Why are these people listening to this?
I actually, about the quadrant, it's interesting. I did this study of great investors and just tried to categorize them and look for patterns. Mm-hmm. And it's funny, about a third of these guys are deep value investors. They're doing either distressed credit stuff, they're doing deep value in equities, which all of which I define as basically something where it's trading below 7 to 10 times earnings, or if it's a credit, it's above, it's yielding above, probably, I don't know, 12 or 15% or whatever it is at the time. And it's funny, so many of them come from that area. And I think if you look at the assets in it, if you just look at all the financial assets in the world, how many are in strategies like that? I bet it's like 1 or 2%.
I heard you say that on Bill's podcast.
I think it's just vanishingly small, and it's because. Did I say that on Bill's podcast?
No. I loved it because I hear what you're saying. It makes me think of what a CIO at a large family office, who I respect because he's smart. He's not the kindest person, but he's very smart and just sharp. And he says that like he thinks like everything's just about deep value or value. It's just like how you manufacture it. Like when you go back and look at early Greenblatt, it was you have to think about the multiples he was paying.
Yeah.
So like everything is just about your entry, like that entry price. How you manufacture it. That's right. That's the modern part of it. Whatever you're doing in a modern context to manufacture it. Like I know you're big into the Chandler brothers, which I love the Chandler brothers. I think they're amazing.
I love that you know who they are. No one knows who they are.
I tried to get them as an investor for many years. They still haven't returned my phone calls or emails, so you're on notice.
They won't return mine either. It's funny, you've reached out to them. I've reached out to them. I'd give my eye teeth to have them partner with me in some way. I've thought so. I wrote them such thoughtful letters and everything, and I've gotten nowhere.
Oh, okay, mine were not thoughtful, so.
I gave them everything I knew, and I was like, oh, they're going to be so interested in this, and I got nothing at first, and then kept pressing, and finally someone was like, we're not interested.
Oh, really? Oh, wow.
Yeah, they have a lot of employees. I didn't know this. I thought it was like them, and they're running kind of a low scale family office, and they each have their own now. But right. They have a lot of employees there, and one of them finally reached out to me and was like, enough.
That's funny.
and I'm going to keep reaching out. I'm not stopping.
Yeah, no. I love it. It reminds me, once I reached out to a guy who was very wealthy. I was trying to talk to him about some of the crypto distress stuff he did. And he said, no, I'm not really interested in this deal. And I only really invest in the areas that I know a lot, that I know the industries I know stuff about. And I wrote back and I was like, oh, okay, I'll keep that in mind. I'll make sure to reach out when stuff comes up that I think is more in your area, which he's a big in transportation and shipping. And he said, no, please don't. And I was like, oh, right. And I just realized, like, if you're, in the B club or something, it must be quite annoying. But that's our job, to be a little, the squeaky wheel gets the grease. So, I
Totally.
think you have to keep reaching out. Funny enough, since you're a big Chandler Brothers fan, uh, I met someone that was a trader for the Chandler Brothers back in the day.
Wow.
Um, and he was like, they would call from like their yacht, like they were on the Med on their yacht, and they'd be like reading the paper, and they'd be like calling us, be like, buy 10 million of blah blah blah, and which was like doing big trades like over the phone from their yacht, and he was like, they were amazing. But I do think it was a bit more, whatever the phrase would be, swashbuckling back in the day. I think they probably just like the guy that worked on the British pound trade, like the travel stock guy, Joe Lewis or whatever, like, it becomes big and you start turning into wealth preservation and you start doing real estates or whatever else you do.
Yeah.
So,
I mean, with them, it's their level of concentration is insane. I really do think as much as I admire them, they did to some degree kind of pump up the variance and kind of on their portfolios and like there is it did not have there is it was not inevitable that they became rich. It was entirely within the realm of possibility that one of their investments where they put most of their money like in Russia or something like that would have
right.
completely epically blown up on them.
How did they play Russia? Did they do vouchers? They were in Renaissance. They were part of like the Renaissance group, weren't they?
I don't
Renaissance capital.
I don't know. I don't know if they were. And I don't know if they were in the vouchers or not. I thought they got involved. The vouchers were 1994, I think, like
Hmm.
around there. I think they got involved later. Maybe they did the vouchers and then came back with that, which is a
Okay.
lot what a lot of people did. They did the vouchers and then came back in the late 90s. But I know they have what I think is one of the greatest trades where they bought Gazprom and basically it fell something like 70 or 80%, and they had I think they had like a third of their net worth in it, maybe even more. They put in, I think their net worth at the time was like a $2 billion or $3 billion, and they put in at least $1 billion
Wow.
into it. And basically, it's so funny because they talk about it and they're like, a lot of people would have said, "Oh, I made a mistake, I got it wrong," but they're just like, "We don't think we're wrong,"
Right.
and they're like, we're kind of optimistic about it," and
Well,
they hung on, and they broke
I,
even.
okay. So a few points there. One, what did you call it? Pump up,
Variance.
pump up the variance. That sounds like like you and Toby need to make like there's gonna be like a song you're gonna do. It's gonna be like a deep value song. We're pump up the variance. Let's go.
It's like
Like,
Christian Slater, pump up the jam or pump up
yeah,
the
yeah. There
volume.
you
Pump
go.
up the volume. Have you seen that?
Yes, of course. I've seen it. That's
Okay.
funny. You could do that for. Well, it's true though. You have to like avail yourself. I have a friend who's kind of like more cerebral on his investments, and he says you have to avail yourselves to the optionality that isn't. He's really into like I can't remember like Archimedes' lever and this idea that you really have to like avail yourself to the optionality that is out there in the world, and uh and it has to be if what you're doing isn't in that possibilities, then that's the one thing I don't like sometimes about investing is I guess like everybody will do it if people are doing it from their home and they're thinking, oh, I'm going to get rich investing into micro caps or something like that or whatever. And people that are managing money can get rich, but you can do okay, but you're not like compounding at 20%, and you're better off
Mhm.
like making higher income for yourself as a doctor, a lawyer, or whatever your small business or big business is. So like that my point is like unless you're really pushing hard on that variance, as you put it, it's not in the possibilities to turn like $5 or $10 million into the kind of wealth that they made over. You have to be just willing to take unbelievable amounts of volatility and risk. I mean, there's other parts of the distribution curve that are zero.
Yeah, I mean, they did 34% for 20 years, which I
Incredible.
which I actually did the math, and that turns $10 million into whatever it is, like $2 to $4 billion.
So that's what we should just talk about. Just a show about how you do that. That's the whole show.
That is, but it is interesting. You are right. I guess I mentioned it just in the context of managing money. It really doesn't work, but and for your own portfolio, like if I were worth $100 million, would I then be putting in 50 million of my money in Russia? I
Right.
probably would. I probably wouldn't. But they kept doing it.
Right.
They
Right.
they,
Right.
they
Right.
literally
Right.
they just never took their foot off the gas for 20 years, which most people I don't think would do that. Most people would just sort of diversify and say, I want to make sure I survive. But they don't see, to your point, they don't see the world that way at all,
Yeah.
evidently. Maybe they do now. Maybe now they don't care so much because it's just, if once you have $2 billion, why are you
I think it's really
doubling that or whatever going to really do for you?
Yeah. I think I think the hard reality if you work in investments where the capital's not yours is client risk or like just career risk of you can't through what is the phrase, right? The market can stay irrational longer than you can stay solvent. Well, you could like do a paraphrase of that and just be like, the market stay irrational longer than you could keep your clients,
Yeah.
or so that's a tough part about having it not being either being early or just having volatility. Like Cliff Sosin and like who's the other guy, Adam Wyden, and these kind of like ultra, concentrated managers. I love them. I love to watch it. It's like a sport for me, but it's got to be very volatile, even to their personal lives, to have that kind of rip roaring, pumping up the vol going on
Yeah.
in their lives.
There is one mutual fund manager I know of who invests somewhat similar to that. But
No way.
he doesn't it's David Iben of Copernic, and he doesn't, but he's not invested in like he doesn't put it all in one company. He's invested in a lot of hard assets, which today all of that stuff trades at 15-year lows, right? He's in gold miners. So he has 25% of his fund, and he manages $8 billion. I don't know how, and he's a deep value guy. He's obviously, I'm sure, had a very difficult time hanging on to all that AUM over the last 10 years and through this performance drought. But he has 25% of his fund, and this is a huge mutual fund in gold miners, which I think is very ballsy. And then he owns like palm oil plantations in Indonesia. So
Yeah.
palm oil is just the cheapest vegetable oil, and vegetable oil has just become very, very cheap. He owns a natural gas, oil stuff, but it's interesting. He just takes these massive swings at things, and most mutual fund people they're
Got
just
to get
they're
his
playing.
name. Let's go. Sign me up.
I've been trying to get him on. I want him on. I've been sending him thoughtful letters.
Oh, you'll get there. You'll get there. Chandler Brothers are probably hard because they were never, they never really managed outside money. The funny thing about so I'm sort of obsessed with the privatization trades. So I've studied them pretty closely, and I've spoken to a lot of people that were involved in some of the trades. I always want to do a podcast called like the oral history of like the privatization trades, because a lot of that history is sort of lost. Like a lot of the investors don't talk about it. Probably because there was a book that came out called like The Siberian Job this year or last year by this John Kleinheim, I think I'm saying it right, who was pretty involved. But a lot of the people who are involved really don't talk about it because they view it as like, I don't know, do we really want to talk about what we did? And like, not that anything's illegal, but it's like some of it's kind of unsavory.
Yeah.
But there was a lot more risk, I guess, is my point, than even people like now, like after the fact. We always like mythologize or come up that, oh, look at this great trade that happened, but people forget how risky it was at the time. Like at then you had to have a local Russian broker, and all the stuff was in his name or her name. Like it was not, you were basically trusting a stranger to hold like all the collateral. I mean, you basically had frontmen because you weren't actually allowed to own the underlying as a foreign investor. So,
Oh, that's crazy. I didn't even know you weren't allowed to own the underlying.
oh
It's
yeah,
I connected with Harvey Sawakin,
oh yeah,
who
yeah,
was one of the founders of Firebird,
yeah, yeah.
along with Dan Cloud and then another guy, I think I can't remember his name. But and they invested in the vouchers, and then they invested again in Russia in 1998, and they made I believe after fees 40 times their money in about 10 years.
Nice.
Yeah.
And they made a business out
It
of it
was,
on the back end.
and then they created Firebird, which is
Right.
obviously going through a very tough time right now because of what's going on in Russia. But I think will be very successful again in the future. But I remember reading something he wrote about it, and he's like, "Oh, I went to Russia to see if it was a real place, and it seemed to be, but it smelled. Just everywhere he went, it smelled. I think it's Harvey who said that. Maybe someone
That's
else.
good. He did an Invest
But
Like the Best, I think, where he talked a bit about it. And I've heard another podcast where he talked about it. Yeah, they were super. Firebird was one of the main characters, you know.
Yeah. But it's really scary, and I mean Russia's a kleptocracy. It's the amount of people who've been pushed out of windows there in the last year or two is insane. It's like all these people just keep getting pushed out of windows left and right. It's really scary.
That probably means we should be trying to find ways to get long. But yes, it couldn't look any bleaker. I mean, you always say that, and it gets bleaker, but it is. It makes you go. No, normally when like the oxygen leaves the room when someone presents an idea, it's probably a good one. It is. There is something really. I actually think Howard Marks does a great job of describing this. He calls it the perversity of risk, and he's like, everyone just risk isn't intrinsic to an asset. It's really a function of price, and everybody still, even though we all think we're level-headed and trying to be rational, we still all make the mistake. I mean, I make the mistake. I'm like,
Totally. I mean, everything. I'm just convinced everything is a momentum trade at the end of the day. Everyone talks about they want value or they want long-term returns, but something goes down for a year, and it's like people look at you like you are a piece of shit.
Toxic.
They hate you. Right now, my mother-in-law has been reaching out to me, and she's like, can you help us? Can you talk with us about investing our money? And in my head, I'm thinking, no, I don't want you to beat the shit out of me emotionally if you go through a rough patch. But it's true. It's really funny. I just think everyone is momentum at the end of the day, and in part that's rational, right? If you're like, oh, this is the way the world works, and you're down 7. If the fund you run is down 70%, people are going to freak out because they're not bought in on it. They don't get the underlying.
Yeah, they don't really know what you're doing. They don't. People don't really know what you're doing. They're like, oh yeah, that sounds great. I remember one time I was, before I have my company now, I sort of ran a small hedge fund. And I had an investor who's, oh yeah, long term, yeah, value, love it. He said, how are we doing this month? And I was like, it's the 9th or the 8th, like of April. Like, what do you mean? He's like, oh, the market's really crazy this month. So how are we doing this month? I was like, I have no clue. I was like, is he listening to anything I'm saying? But I mean, it's just like the you have to, it's easy to say, it's harder to follow. It's just like, eating habits or a workout regimen. Yeah, we kind of have a basic idea about what we should do, but it's quite hard to follow. That's why I think there is something to be said. In Cliff Asness, I'm sure you follow some of his stuff. He has that great, like, every strategy should be good, but also have like a level of stick-to-itiveness. He says, which is a made-up word that I've made up. It has to be something you'll actually stick to. Because if it's like super hardcore, but you'll never stick to it, that's a bad strategy. And I think there's something to be said for that. There's like a balance between like hopefully being a hardcore kick ass. You said I could use bad words. Strategy, but having a level of stick to itiveness so that whoever you're doing it with hopefully will stay the course. through the thick and thin.
Oh, that is my biggest fear in another investor. Someone who's sort of like, oh, I believe in, I believe in value, but I also like quality, and then I also do a little macro, and I do all these things. And it's like, okay, so basically, when the going gets tough, you just flit from one thing to the next, or it's like people like you read write ups on Sum Zero or Value Investors Club, and people are like, this is going to do X for, could make three times more, and it's a quality business over the next 3 years. And then they have a bad quarter, and they're like, oh yeah, that invalidated the thesis. I'm closing out the idea, and it's like, well, wait, what? I thought we were on this train together. You're pulling the plug already? I'm always so surprised by how quickly people change their minds. I guess I change my mind really slowly.
I mean, I got nothing. I mean, people. I mean, I think there's something really nice about illiquidity in investments because it kind of like does this. You're kind of like, the hands are tied to the mask. You got to see this thing through. I think sometimes that's good for you psychologically.
Oh yeah. Oh no. That's my. I think my mic cut out or the connection cut out
It
for a
did.
second. But
Okay,
yeah,
sorry.
I agree with what you're saying. Yeah, it's something where you're in it. You're stuck. I think that's actually a very good thing. And whether you're
I think it's a great
doing that
thing.
yourself or it's coming from the world, it's very good. And I think the Chandlers totally vindicate that. I think almost all their investments were at some point down some horrific amount. Like they
Right.
invested in Brazil, the largest Brazilian telecom firm, and I think they bought in that, and then that was down 50%, and they basically put in, I think 2/3 of their money or something crazy on it,
Wow.
and but they just didn't sell.
I mean,
But that's a rare
you
trait.
yeah, but I mean, you have to be. I think you said it like you have to have in the set of possibilities this huge outperformances. That's what you're going for, and that includes like pretty extreme. You have to there's be pretty extreme things that you're doing. I also think what's interesting is so I'm friendly with the son of a pretty famous value investor, and I was like, one of the things I think people don't always appreciate is some of those like amazing track records that you see. These are people that kind of invented a category of investing. Like the Chandlers
Hmm.
kind of invented a category in some sense, like frontier emerging markets. Like that was like super. John Templeton, I guess, was sort of very international early. Uh, Howard Marks and others like invented kind of distressed. There was no distressed institutional distressed asset class. Now there is guys that invented converts and like structured credit. Those guys have great track records, but you have to kind of be a pro generator or not a pro generator, but kind of like in some sense you have to kind of I think be early in the invention of a strategy. I think that's a good way to have a great track record. Um, uh, because yeah, think about it. Like Howard Marks, this guy's really invented. There was no institutional distress. Now there's like a huge world of institutional distress managers.
Yeah.
Um,
Oh, it was unthinkable back in the 70s. I mean, that was Milken's thing, right? There was some study that he did or someone else did where they looked at junk bonds and they actually paid out enough to make them worth buying
yeah,
as a category. And people it wasn't generally thought of that way, and it just completely changed everything.
yeah, it was Milken. Yeah, yeah, yeah. I mean, I've heard good and bad things about Milken. I kind of think he's a genius. Uh, uh, and yeah, that's the study about like returns on fallen angels. I think it's, but I think it's true. Like, that's I started working on crypto distress because, it was greenfield. Like, no one wanted to compete with us, and so I was like, oh, I can own this little area that that a lot of the firms won't compete with us on, and I've just kind of tried to follow the thread of that because and it's fun for me because it's interesting, it's provocative and different in the sense of like there's a lot of unanswered legal questions, and but the spreads are very big compared to traditional distressed trades. If you were to take any sort of like for like and put numbers against numbers, once you put crypto on it, it really does have quite a big taint. And I mean, you could probably say that um, the only implicit bet when you're doing that is that the volumes will increase over time. Like it'll still be a thing
Mhm.
in 10 years or 20 years, or it'll be a bigger thing than it is today, which is a big bet. But I suppose, yeah. But I do love the I mean, if I wasn't doing this and if I had more capital, I don't know, like the international area, of course, is like amazing. I think people are so US centric. I mean, I'm sure you probably see it in the data and the way you approach things. Sounds like you're looking at China and stuff like that. You start saying China and like people just go like, oh man, like you can't, how do you even get comfortable with the rule of law? It's like, okay, well, look at the discounts and, get smart. Like you can hire people on the ground, you can channel check stuff pretty, yes, okay, maybe you get caught in a thing here or there, but my point is like, I think as long as you feel like you're getting compensated for the risk, and there's where the gold probably is, so.
Yeah. Oh, definitely. I remember I was at a doctor's office and this woman was asking me what I did. And then she was like, "What do you hold?"
Uh-oh.
She's like, "I used to work at a hedge fund." And I was like,
Uh-oh.
"Oh, what?" I was like, "Oh, I own, X, Y, and Z. I own a bunch of stuff in China, and I own, some other stuff in, in emerging markets." And she's like, "Oh, you own really risky stuff." And I didn't quite know what to say. I was like, "No, I think the stuff you think is safe is risky. Actually, I want to be
Yeah, yeah,
polite."
yeah. It's all a
But
function of
you're
price. Center of the Howard
totally.
Marks memo.
But your stuff, turning to what you do, crypto distressed. When I first heard that, I was like, that was something where I was like, wait, what is that?
It
That
is
that
risky
that that
though. I just think
is
you get
it?
compensated.
Yeah, but that's one of those things. I'd never even heard of it. I was like, what is this? Because crypto is just kind of in the last 5 years entered the lexicon, and you're already doing the distress stuff on it. It's not some intuitive thing. It's right. People's minds when they think of crypto don't go to crypto distressed.
Right. I was at a crypto conference in like
But
2000. Sorry, go ahead.
no, go ahead. Finish your story.
No, there's a little lag. I think. I'm sorry. It's my Wi-Fi. I was at a crypto conference 2017-18, and there was a guy from Passport Capital, which is like a big, just like like hedge fund. You were in hedge funds, so maybe I can't remember if they're still around. But it was a big time firm then, and they had started a crypto arm. And I said, hey, dude, I know you're into crypto. This is great. He was a keynote at the thing. So I like, right when he walks off stage, I like run up to him and like accost him. And I said, hey, I'm Thomas Brazil. I work on crypto distress. And he says, crypto distress? He's like, is that a thing? And I was like, well, I buy these Mt. Gox claims. Like, this is how it works. I'm like, he's literally like trying to leave. And I'm like, just talking in his ear the whole time. And I'm like, he's like, oh, well, here's my business card. Shoot me an email with some stuff. He's like, huh? You learn something new every day. Didn't know crypto distress was a thing. And I was like, yeah, it's a thing. It's a thing. And it's gonna be a thing because we'll have huge cycles. And uh, so it is true that it is somewhat a new thing. My only real implicit bet was that crypto was kind of here to stay, and that you would have huge cycles because it's such a volatile asset. Um, and those are really kind of the only bets. But it is risky. I don't want to act like it's not risky. The difference, I think, is I think you get overly compensated for the risk. Now, it doesn't mean on every trade is going to work out. But on the whole, I think that there is a ton of opportunity because the stuff is small, the stuff is weird, the stuff is new. There's a lot of unanswered legal questions um, around restructuring and stuff like that. And the institutional guys still haven't really showed up to the party. I mean, yes, in FTX, you have lots of big institutions who buy claims and things like that. But if you leave FTX, the list goes from 100 firms down to 10, and then down to 5 and to 2 very quickly. And what's interesting is the crypto guys don't like distress because they don't understand the legal stuff, and sometimes they don't like the idea of distress because it's almost like an anti-ESG thing. It's like, wait, you're buying what? These tainted assets, yuck, 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 yuck. Because most of them are venture capital types. And the distress guys don't like crypto because they're like, ooh, crypto, that's weird. Like, can you give me some hard assets? Give me a piece of real estate, give me a piece of steel. Don't give me, like code. So
Yeah.
that kind of, that small intersection of overlap is kind of, I always think that's true of anything too in a business. You take like two disciplines. I think it's like Naval or someone that says this, or it might be another guy. But if you have like two disciplines that are kind of disparate disciplines, and you put them together in that like small area of Venn diagram where they overlap, is probably where you can make a nice little business, or hopefully make some outsized returns. So that's how it really started. And I mean, I can go into details on some of the stuff, but it's 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 fascinating. And I mean, I kind of just fell into it because I thought it was interesting, and then no one would work on it, and I got 1,000 no's, and I was like, 1,000 no's. This is probably interesting then. And the pricing was always very good. I was always like just kind of blown away at the numbers. When you like walk anybody through the normal numbers of stuff, they're like, "Oh, I totally get that." And normally the response, like even if you pitch, this is so funny. I would pitch like a big hedge fund on like I don't know buying Mt. Gox claims, and they'd be like, "Oh, we would never do that." And then I would get like a phone call or an email the next day from like one of the guys that I met with, be like, "Hey, so the fund can't do it. So like, do you think I could buy like $1 million of this stuff?" Like so I would get calls like that, and I'd be like, I remember once we had a meeting with a pretty big firm out of Chicago, and they were like, "Oh yeah, we would never do this," and I was like, "Oh okay," and then literally three of the five people that were on the call like wanted like to put like $250,000 into like a PA trade, and I was like, "Guys, come on!" Like,
That's interesting. I mean, that's it's frustrating that you're not immediately getting the money, but that's a good sign.
I thought it
That's
was
a
a good
very
sign.
good sign.
Yeah, yeah,
Yeah.
yeah. They were like too scalable. We have to get past IC compliance. It'll be a compliance nightmare. Uh, we just don't think it's scalable enough for all of the extra cost and risk that it puts on our firm. That was always the pushback if someone was being thoughtful, I think, and actually looked at the materials.
Yeah. It's a niche. I mean, it's like a
Yeah,
real niche. Everyone uses that term, but this is actually one.
we're a small
What
cap manager, very niche. Yeah.
what what gives you the confidence? So when an exchange fails, what gives you the confidence to invest in there? How
So
do you know anything's there?
yeah, yeah, yeah. Okay, so um, Mt. Gox was literally we were just buying Bitcoin for a third of the market price. Then the trustee sold about a fifth of the Bitcoin and had like $600 million in cash, and we were buying below the cash value on in the estate. So the first trade was just kind of okay, but
Hmm.
then in 2018 when he sold a fifth of the Bitcoin, he raised about 650 in cash, and we were buying at a valuation below the 650. So we were getting the Bitcoin for free. So we're like, that's a trade we can get
Okay.
behind. And then if you fast forward to some of the other dockets, like an FTX, really, really early on, it was very difficult, and you were trying to put together a puzzle like with the lights turned off, and where the puzzle pieces were kind of like shape shifting on you. Like, is this really, so like there was talk about the estate having 13 billion of liability, and we knew some assets were out there. We knew like the Robinhood shares were out there. We knew there was like 800 million or $1 billion of crypto on chain, and we knew that just a smattering of things. And you say, okay, you probably have 13 and you probably have 2. Okay, what is that, right? You're saying, okay, maybe that's 10 cents on the dollar. Plus, you have what are called causes of action, which are either preferences for people that received got their capital off within 90 days of bankruptcy. So you add up all those assets, it was like, okay, there's probably something like 10, 15 cents, and we can buy them for 6. And, when you buy something at a low basis, there's a lot of optionality. But we had no way of knowing that it would be, I don't think us or even the big smart firms with all their analytical ability and ability to hire consultants, stuff like that, and pay for access. I don't think they had any knowledge that it would be 100% repay, because the more you got under the covers of the company, the more assets they found and the more things came to light, and the more the trade shaped up. But again, it's like and also it's happened very, very fast, which is very atypical. I mean, generally these are slow. I mean, I guess Madoff was like 65, 70 cent recovery, but it took 10 years, 10 years plus, I think, even. Same with like, I mean, MF Global maybe was decently fast, but like Lehman took 10 years. But yeah, okay, people got 130 at par. because they got post-position interest and stuff like that, which is what was probably going to happen in FTX. But you were always sort of like buying optionality and like getting a stake and a sizzle, right? Like that was kind of, if you love, I always love that quote because it's so, it makes you, it's visual, right? Like the stake and sizzle. So I think in some of this distress stuff and the crypto distress as well, there's really a stake and sizzle. You have to kind of like buy that stake and be like, okay, well, I'm making a double and I'm okay with that. But there's a possibility of getting some real sizzle, which is I'm not in a dying asset class. Um, so that was kind of interesting compared to most. Like you look at retail bankruptcies and stuff like that. Like those are dying companies. Those are like dying asset classes, and it's hard to get sizzle. Like you know. So so that's how you approach it. You're trying to get something cheap and avail yourself to optionality, I think. And claims trading and buying and sourcing is a skill. I don't know that that's alpha. I think that's. Have you ever read? There's this great paper by Andrew Ratliff, the guy that founded Whitebox, about like alpha and beta scalping. And he says like a lot of like niche managers think they create alpha, but they actually are beta scalpers. And he's like, there's nothing wrong with beta scalping. He basically means like what you're doing is decently niche and sophisticated to where you should make an excess return over like the risk-free rate, just because of the cost and it's just like the friction. There's the know-how and the lack of scalability. So he's basically saying like if you have a risk-free rate and then you have like an equity market risk premium, maybe you're doing I don't know litigation finance of some particular type of litigation finance, or you're doing what does it people do? They like buy tax liens. Like you're doing tax liens. It's like not super scalable. You have high returns, but it's not scalable. And you need to know the states and counties, and you need to have the connections and all that stuff. And to do all that effectively, like you should be really making 15%. That's not really alpha.
Right.
That's beta, but and then you're splitting that beta scalping with your investor. So you're getting maybe 20 or 30% promote. They're getting net 12, net 15, whatever. And so you really should be making that. That's not really like alpha. That's just for all the time and, that you're putting into this effort.
Oh yeah, that's interesting. And I assume your hope
Great
is
paper.
that basically as crypto grows that obviously it's going to be a bumpy ride and there's going to be a lot of distress along the way, which it's proven to be already.
Fruitful ground. I think yes. I mean, these were a bunch of the ones that this cycle. It was a lot of centralized finance companies that were masquerading as crypto companies, right? Without any regulation. I mean, it's basically an entire shadow financial system of guys trying to play around with crypto. Which cool, down with playing around with crypto. The problem is like all these centralized actors, meaning like these exchanges and these like lending platforms, which didn't have a lot of regulation around what they were doing. I mean, Voyager went under because it gave $600 million to a hedge fund sort of sight unseen. It was like, we're good for it. No need to do a lot of due diligence. Just here's a check.
Yeah.
And that would never happen if you were a bank or an e-broker of some type, because the founder of Voyager, or at least the CEO towards the end, was the founder of E-Trade. You could never do that. You can't just punt with the balance sheet. I mean, that's why MF Global, I guess, got in trouble is whatever his name started punting with the balance sheet. Actually, the trade ended up working, as my understanding. Yeah, so it's been fruitful because of all that, and it's a super volatile asset. I mean, I wouldn't say I'm crazy into most parts of crypto. I definitely get the idea of a lot of it, and I think it's cool. I mean, it's kind of like a grand experiment, a lot of it. So I mean, you can't justify $28 billion valuation for whatever new token like WorldCoin or something like that. I mean, it's just an idea. So, but I mean, Bitcoin is a little easier, right? It's sort of like a finished product. And stateless money is kind of a cool idea.
Yeah.
Bitcoin is kind of like a religion versus most of crypto, which is like fintech. So they're a little different. I would say I think the Bitcoin guys are more fun to hang out with.
I think at one point when we first started messaging each other through WhatsApp. Like I accidentally video called you or something, and then immediately shut it off. And I was like, oh, I was like, oh, I was like, sorry, I just did that. That's very, very aggressive. And you were like, oh no, I do a lot of work in Bitcoin. I'm used to it. I was like,
Oh, really?
yeah, yeah. I was like, okay, this is that
No, people.
tracks.
Oh,
That
yeah, yeah,
tracks.
yeah. I mean, look, I've met a lot of like early crypto adopters, whether OGs, like people that are well known in crypto, or like even cypherpunks. I mean, I bought like a Mt. Gox claim off of an original cypherpunk, like kind of incredible to think about. And their ideas were just, I don't know, things have it's turned into like a whole like let's revolutionize and make Web3 and money like a thing altogether, and it's some of it's kind of a great way to fundraise. Some of it will work, a lot of it won't. It's probably
Mm.
good for humanity, so who cares? And in the meantime, hopefully there'll be cycles, pretty big cycles, because something will blow up. There'll be another Terra Luna that doesn't work, and it'll blow up, and someone will get caught and get pulled under by it. So
I'm curious what originally attracted you to investing?
me, I was sort of always, when I was a kid, I was like always obsessed with like sort of business, and when I was a kid, I just thought I wanted to be Warren Buffett or something. And then I, can you still hear me? Because I feel like might have cut out. Am I still here?
Yeah, yeah, yeah. You cut out just for a sec, but you came right
Okay.
back.
I was always sort of obsessed with business, and then from there, investing. And I used to think, and I still think, Buffett's the goat. But I used to like worship at the feet of Buffett. And actually, crypto was good for me because it sort of like made me sort of break my idols. Because people like Warren Buffett, and Charlie Munger, who I have unbelievable amounts of respect for them, were like, "Oh, this is rat poison. Don't spend any time on it."
Yeah.
And so it was hard for
Well,
me because I was really in the closet. I was like, "Oh man, like I can't. It's so hard for me." You know what I mean? It's sort of like
no, totally.
your
Oh yeah,
idol's saying this is trash.
yeah, that's right. Everyone in the value community knows what you're doing is irresponsible, right?
Yeah.
That's the way they treat it.
I still have people who call me and say things like, "Oh, are you still working on that crypto crap or that crypto shit? Like, when are you gonna get back to like working on real deals?" And I'm like, "Huh, okay." Or my favorite is well, you said you were at a doctor's office and so, "Oh, what do you do?" And you say, and they start asking about investments. That's like you don't mind doing it if the person's actually open, but you'll get people who they almost want you to defend something.
Oh
And
god.
with crypto, it becomes like a real thing. Like people are like, I mean, crypto's total BS, right? And you're like, I gotta go get another drink. It's nice to meet you. It's like I was like,
It's
I'm
it's
not gonna do this.
it's terrible. I actually met with a family office recently, and it was a terrible meeting. I don't even know why the guy called me. I was just mystified. When he first called me, he was very strange, and I was like, okay, well, this is a lot of value. People are just really odd, but they can be wonderful people, and he was just really freaking odd. And like we exchanged some pleasantries, and he was like, okay, all right, let's sort of like annoyed with it, like, all right, let's get down to it. And then is like just starts telling me, he's like, starts dumping on value and all this stuff. And we actually started arguing. I didn't know whether to argue back or just sort of be like, well, maybe this isn't a fit. But I just didn't know did he want me to like change his mind or not. So finally I was just politely arguing back, and it kind of devolved into us arguing. It was terrible. It was like the worst meeting I've ever had with someone.
I mean,
But I
sometimes people I think are testing your metal.
Yeah,
Uh,
yeah, and if they are, like, I argued it back, but then I realized he wasn't. Like, he really just disagreed with me, and like we were just like two idiots arguing who were never going to work together, and I just felt like a total fool.
I mean, look, sometimes I think it's yeah, raising money or having clients is a little bit of a numbers game where you have to find people that like what you already do, not just like you don't need to convert people. Like I always have this saying that you shouldn't try to convert people. You should just try to find people that are already interested in what you do, or already want to buy what you're selling, kind of thing. So it's
Totally.
not about like converting people. And I think that's a mistake I made when I was younger. Is getting to a quick no is just as good as trying to convert, because converting people is just like extremely hard. Just say like,
Oh yeah.
not good. Well, hey, see, I think we're at the half-hour mark here. Let's just go ahead and like call it a day, as opposed to it being an hour or 2 hours or whatever, or a second meeting when you're just trying to convince someone that's not that interested to begin with. So like get fast no's are just as good as anything. And it could save you time to work on real prospects. I mean, in sales they talk about it, and I think raising money. If you believe in what you're doing, you're not a total shill. Then you should just find people that are interested in what you're doing. So,
Oh, totally. It's totally a numbers game too. I remember I met my wife on Match.com, which I don't know if
you're going
yeah,
from you're going. Don't call it a numbers game.
well, no, I went out on probably 100 dates, and I met my
Oh
wife.
wow.
She was, yeah. She wasn't even the last one I met either, because I had like a list I was trying to work through, and then I met her, and I was like, oh, this girl's pretty cool, and so I had like I had like a little like wait list I was trying to get through, and I went out with my wife once, and then I quickly went out with the others, and then wound up, and then didn't see them again, and wound up with my wife. But
Wow.
I'm all about the numbers game. Everything is a numbers game. It really is. It's kind of crazy.
I think there's something to be said for that. I think, and yeah, that is a good use of Match.com. They're gonna like sponsor your show now.
They don't exist anymore.
Oh yeah, they don't. I see.
I don't think so.
I don't know what's going on. But I mean, I think it's a numbers game, and just finding people that are interested in what you're doing, and as long as you're, and taking criticism is good, but trying to convince people is just like trying to convert people. It's probably a better word, but convince is fine. Convert is bad. Maybe that's the best way to say it. So I don't know. Just life's too short for all that. Gotta get to the quick no.
Yeah, I don't think I've ever been able to convince anyone of anything in my whole life. I think they either want to believe it or they don't. That's my fatalistic theory on it.
No, I don't disagree with you in some level. So I kind of, that's kind of what I'm saying. I feel like you just go find someone that already wants what you're doing. They just don't know that you exist, or they don't know that what you exists in your wrapper that you're doing it. In the context that you're doing it. So when you say it, it's like you're on a frequency that they're already kind of looking for. They just haven't found that they're down here and you're up here, but the same wavelength, and you just match up. I just think it's better to do that than trying to just like cold convince, or and people do it in crypto. Like I try to be a bit thoughtful. I don't want to just approach anybody about stuff. And when someone ever gives me the whole crypto, convince me on crypto, I'm like, I stopped doing that a long time ago.
Yeah, that's good. I know exactly what you're talking about too.
Convince me that value investing still works. You're like, don't do that anymore.
Yeah. Convince me you don't suck.
Yeah, why should I
It's
invest with you versus just buying an ETF or something? I don't know what people say. I assume it's, why can't I not get this passively, is probably the big knock on a lot of investment managers in general. I think it's important to have a differentiated strategy, right? Or something that differentiates you in the market. But I don't know. If someone's really an uphill battle on it, I think it's like, yeah, you're right. You should just passively index. It's not a bad strategy.
No. I want to wrap it up soon. I try to keep them to an hour.
Oh yeah, sorry. Go for it.
No. I'm the one keeping you. But I'm curious. What? So with investing, is your interest in investing about getting financial independence, or is there some kind of sort of individuality that you like to express through your work? Like what is the part of it that really appeals to you?
For myself, I assume it's like I don't come at it. I view it as it sounds ridiculous. I view it as like self-expression, the same way that, I don't know, Bob Dylan writes a song. Like I really feel like I hope I can express myself through an investment, even though it's not possible, and I'll always yearn for more expression. I will never actually achieve, like, what is it, like Plato's chair or something. I'll never actually attain that idyllic, idea of a chair. But for me, I've always been fascinated with like the greatest trades and the greatest investors, and I I guess my recent kick in the last couple of years is like I don't read investment books. Like I really really hate finance and investment books. I love reading
Mhm.
biographies of people that have like crushed it in some area. Like I'm in the middle of, the Phillips brothers, which is Philbro, which is a big kind of like a Glencore or Glencore or kind of like Progenerator. They were metal traders, and kind of like I don't know. Just I'm fascinated with ideas and how people have like maybe crushed it. So I read this book about this guy named E.P. Taylor, and he's sort of like he basically during the Prohibition he was buying all of these Canadian breweries, and not just breweries, there were bottlers and breweries. So the whole idea was it's one idea. When Prohibition ends, I will crush it because I'm buying these well below replacement cost. And when it happens, I don't know when it'll happen. As long as I can get to the other side, I will just crush it. It was one idea, and of
That's
course,
amazing. That's an
and I just
amazing idea.
and I just kind of love that some of that stuff, like one idea stuff, like the guy that. Did you ever hear the story of the guy that bought like the bridge between like Detroit and like can't like there's a bridge, there's a famous bridge that goes from.
The
I'm
Monarch
sure.
Bridge or something
Is it?
like that.
Yeah, it's a famous thing. It was like a publicly traded company, and he like bought it out for like $250 million or something, which was a lot of money back then, or it might have been 150 million. It was a lot of money in like the 70s. And Buffett actually owned the stock, owned the security. This guy bought it out. Now he's like worth $9 billion. So it's just like just one idea that. So I'm sort of obsessed with the idea. Did you know the story of? Oh gosh, what is it now? Oh, the OC. What's the OC? You spent some time in LA, Orange County, and the. Oh God, it's got to come to my brain.
What in the '90s with their
No, 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 no. There's the guy that owns most of Irvine, the Irvine Ranch story. Do you know the story?
Oh no, I don't know that.
Oh wow, it's fascinating. You would love this kind of stuff. So, this guy, Irvine Ranch was. It was. I think it was. I'm not sure if it was a public company. I don't think it was. Maybe it was, but it was sort of bought out, and it was a huge Irvine Ranch. It was like whatever orange orchards or something. And this guy who's now famous, who's like billionaire, it's like $15 billion or his net worth or something like estimated like that. And it was just like one trade. And actually, interestingly, there were a number of people in the trade. And there's a great book by the Taubman guy, who's sort of the inventor of the modern day mall. He
Hmm.
invested in this deal, and they bought it for like I can't remember something like a few $100 million, and they all made like five times their money, and they thought they'd crushed it, right? Five times their money. Wow, wow, wow. And
Right.
meanwhile, the Braun guy who owns like all of Orange County, like he stayed with the trade all the way through. One idea. They're not building more, like seaside California real estate. This is like think in the 70s or sometime. Again, it was expensive. Inflation was high, things like that, and of course turned like $100 million into whatever, 15 billion or something.
That's
So I'm sort of
crazy.
obsessed
I'm
with stuff
obsessed
like
with that
this.
stuff too. There's something about it. There's something about it where it's like, and I feel the same way you do. I want investing to express my individuality. And I want it. I want there to be some virtue in it. That's what's exciting to me is like no one else sees something and you sees the value of something and you do the work and see it. And there's something about that. Like there's a virtue to it, and that's really exciting. And there's also an adventure. I
Yes.
like it when something's a little bit of an adventure. Like these people
Yeah.
who are like, oh yeah, you just buy quality businesses and you outperform the index by 1% a year. I'd hang myself if that was investing. I'd just hang myself out of boredom. It'd be awful. I want there to be chaos or something to just never even be thought about in the first place. There's just something about believing in something that no one else does that I've always loved that. It's just something that is it's like with a book. You love your book and believe in it before anyone even knows it exists. And it's like there's something about that that's so fucking cool. And I feel the same thing with investing. So I was so happy to say that you express your individuality through it. I thought you were going to be like, "Oh no, I'm evidence based." It's what the hell are you talking about? I'm not insane. I'm so glad
Well,
you went the other way.
I mean, look, I think they're look, the institutions we're doing a different game. Like if you're a big institution, The your unique advantages are you have huge scale, unbelievable resources, unbelievable reach. People actually return your emails, right? When
Yeah.
Oaktree emails you, you generally get a response. If Scott or Tom, like, emails you, maybe there's no response. Who is this person? Maybe I need to Google them. Like, what are their qualifications? Why would I reply? So, but the difference is, smaller deals matter to us. We can look at stuff they can't look at. We can do stuff they can't. We can do sort of iconoclastic things that for them might be harder to do. Iconoclastic thing for Ruffer in the UK, which is one of the first firms to kind of allocate a bit to Bitcoin, was putting like 1% of their portfolio in Bitcoin. It's like, oh, okay, well, okay. It's like, and I'm not saying that's good or bad. I'm just saying their unique advantages are theirs and ours are different. And so I try to do that. But I love the adventure of investing. I think it's fascinating. I mean, I on a weekend, instead of yes, I'm hanging with my family, but if I'm not doing that, I'm looking at something so ridiculously obscure that will probably need nowhere that I probably need to have my head examined. I'm like, am I really looking at some private equity deal that somebody showed me in Africa or God knows what else? Some crazy whatever. Just deals that either private or public. I mean, you'll have people that, but I'm just deeply fascinated with that stuff. And yeah.
I am too. There's something about it. Do you like being where no one else is? Is that part of the thrill, or is that just you're not even thinking about it in those terms? Are you more just like I just want to do something that is really going to make a lot of
Yeah, I think
money?
there's something to be said for that. It's a really bad trait though, because it's bad for your career. It's sort of probably good for your investments, bad for your career.
Yeah.
To like always be running from where the money is. You're like, oh, there's money here now. I'm not interested in this.
Not even
Um,
money necessarily, like just attention where
right.
mind share is.
Like people are into this. I'm over this. Like you know, like I think it's funny. There's one of my favorite, actually, yeah, he's my favorite investor. This guy named Andrew Weiss. Have you ever run across Andy Weiss?
No, no, I haven't.
Oh man, whoa, Scott, Bobby. Let me teach you
Let me
the
write down his
ways.
name.
Yeah, and I'll shoot you his information. He doesn't run that much money. Like I think they do like he has like a 700 million I think ish fund that does actually like sort of modern day pure arbitrage. But one of his
Hmm.
early things, he was an accomplished economist actually, like a PhD economist, and then he got into investing. I think looking at closed end funds in Europe. Mainly, actually, one of the first things he was doing is the voucher funds. They had these voucher funds that you could buy traded in Europe, and it was like the vouchers were already cheap. Then you had the discounts on the closed end funds. So it was like, Russian doll, like it's actually appropriate to use
Right.
Russian doll. It was like the Russian doll of like discounts. And so the look through was like, you're buying this stuff for 5 and 10 cents because you had like the discount of whatever it was to the whatever, and then so that's how I got started. I'll send you I have an old Vic, or not Vic, an old what are they called? Like Outstanding Investors Digest, like an OID on him that was really great. He doesn't give that many talks. There used to be one of Columbia, but they sort of took it down. Columbia took down a lot of their old videos, which is
Yeah.
um, their value investing videos. But the long story short is, he says, I could teach you how to make money in the markets, but I can't teach you to be happy in the world because most of what will make you good as an investor will make you very irritating to the rest of the world, your spouse or the board you're on or the club you're involved in, because there's like a give and a get there. So he was saying how he was on the board of some nonprofit and they accused him of being not being a team player. And he was like, "Oh, well, that's great. That's a compliment." And I was like, "Oh, right. You mean that as an insult?" Because he was so used to having the sort of investment mindset of you don't really want team players. You kind of want like it's more like red shirting everything and trying to make just trying to be the contrarian. And so I think he's right in some sense. Like some of the things that make you probably uh, not great as an investor, but help you excel in investing, make you horrible for the world. Like they're really bad trades outside of the context of the perversity of risk.
I could definitely see that. I could definitely see that. I'm struggling with that a little bit myself right now.
Yeah,
But listen,
I mean, yeah.
oh no, go ahead. Sorry.
No. I'm done. I'm done. That's fine.
Okay. I want to be respectful of your time, but I'd love to have you on again. I feel like we were just kind of getting started on a lot of this stuff. But thank you for coming on, Tom. I really appreciate it.
Scott, thanks for having me on. Great to chat.